This podcast is proudly brought to you by Term Plus. What I like about Term Plus is its easy to use online platform, giving you access to high-yield term-based accounts, providing consistent monthly income. Owned and operated by Pengana, an ASX-listed company with 23 years of experience, Term Plus is democratizing access to global private credit markets. Visit termplus.com.au to learn more and read the PDS before investing. Scott, thanks for taking some time to join me on the show.
Pleasure. Thanks for having me with you.
It's good to be here in Melbourne recording with you.
It is.
We're going to talk about wealth throughout the generations, a lot of behavioural finance, no doubt, how families plan and think long term, and also how you think as an advisor to these families and to individuals as really entrepreneurial people. When we spoke recently, you used this phrase, I think it was like T1 or T2. I can't remember the exact phrasing that you used. But maybe this might help set the scene for what we are going to talk about. So can you define those terms and the types of people that you advise?
Sure. So we sort of refer to Tier 1, Tier 2, Tier 3. Now, I must say that I stole that. It's plagiarised from colleagues of mine at Deloitte who have been really visionary in developing this framework. And that's what it is. It's a framework as to how we can look and address families across the generation. So typically Tier 1 would be the matriarch or patriarch that has built a business, that has generated the wealth at that first level. Tier 2 would be perhaps the second generation or the children, perhaps the stewards. And then Tier 3 would be, perhaps the grandchildren of, the founder. So I guess looking at it like that, it's a framework of which you can address the whole of the family. And as we've progressed, as we've moved, the wealth throughout the last 30 years in particular, having that framework to be able to understand how we're, succeeding across those different tiers, so to speak. So that's that definition. Yeah.
It's when you started talking to me about this today, I was really struck by it because I thought you said something along the lines of like the wealth extending beyond lifetimes. And for most people listening to this, to think that way is, some people might at the end of their life think, well, I'm going to give an inheritance, or there's going to be some amount of thing that I can do, an altruistic thing, maybe potentially philanthropy, that sort of thing. But to think that it goes for generations is something that's quite, unique in the types of clients that you deal with. When we think about Tier 3, what does that look like to you? Someone that has that level of wealth.
So Tier 3 will start to look at inheriting over the coming, decades.
Yeah.
So we've got to make sure that we understand who Tier 3 are and how they are ready to receive that wealth. Are we educating them? Are we communicating with them? Are we providing them with the tools to be able to receive that wealth so you get successful outcomes? And I think successful outcomes aren't just material or aren't just investment. It talks about how those people are going to live their own lives to get the best utility out of their lives. So, for any good functioning human being, you want to have a sense of purpose. You want to feel a feeling of achievement. And to do that, you generally have that through doing work, having something in your life that you're achieving. So if you get a bunch of money and that takes, your desire or need to work, then, perhaps that's a less than optimal outcome. So we've got to think about Tier 3 in terms of how ready they are, how educated they are to receive that money.
Yeah. We'll come back to some of those lessons and things that can pass through the generations. So this sounds like a really interesting career that you've embarked upon, and the types of people that you speak to must be really fascinating too. But I'd like to just focus on you for a moment. Where did the interest and fascination for finance come from? Like, how did you get started in this industry?
So my career has evolved over the last 30 years, and my thinking has evolved a lot also. No question that you get better at what you do the more experience you have. But my interest in finance was really sparked, I guess, in the 80s when I was in secondary school about to graduate, and I was always interested in the share market. And then I found myself in London, and the heady times of London in the 90s was a fabulous period. And it was kind of Aussies going there and working for investment banks. And I was lucky. I just got a job in an investment bank. I wasn't doing much. I was more like a spreadsheet jockey. But I got exposed to it, and it was a really enjoyable experience. I came back and I was lucky enough to be, recruited into a stockbroking firm. And I was working at a firm called Merrill Lynch. And I remember advising someone about buying some stocks, maybe it was the Coles Myer stocks to get the discount card back in the day. And I remember a client said, well, I need to consult with my financial advisor first. And I thought, well, what am I? And, it was sort of the first thing in my mind that, provided me with the impetus to start thinking about whole of wealth or providing advice more beyond one asset class. And, my career evolved from there. I moved from Merrill Lynch to UBS, and UBS was a fabulous place to work. And I, learnt a lot from some great mentors there. But I remember thinking my job needs to be focused on all of wallet advice, looking at all of the different asset classes. And, my thinking has evolved a lot as to how to manage portfolios, how to construct portfolios, and how large families need to think about, large, investment of large portfolios through the generations.
So knowing that you like to read and these types of things, are there any books or anything that influenced you or would recommend to someone else today?
I follow Ben Carlson and The Wealth of Common Sense. I just think it's really cool. It just makes so much common sense, and it's more macro and it's storytelling. It's really, really interesting. So I follow that blog. Morgan Housel, I think, is a genius, and he wrote a book called The Psychology of Money, and that's a compilation of a number of his blog posts, which he brought into a book. And I think it's really cool. And I'm a bit of a behavioural finance believer. I think a lot of finance is about the behaviours and making decisions at the right time and the wrong time. So they're two people that, Ritholtz Wealth Management run a couple of podcasts as well with Ben and Ben Carlson and Michael Batnick and a few of those people. I was fortunate enough to go with your colleagues to on the Inside Network to Future Proof in LA last year, which was, kind of wealth management on steroids in a convention, and it was really, really cool. And I got to meet some of these people, and their approach to managing money from a common sense perspective was really great to see. And so to be able to come back to Australia and listen to their podcasts is kind of cool. Yeah,
it is. Yeah, Morgan's been a guest on the show before.
Has he?
Yeah, back in
Fantastic.
the day. So no, it's great. Absolutely wonderful book, and Ben Carlson's work is too. I'll put links in the show notes.
I met Ben, and he was a really great fella. Actually, I really enjoyed speaking to him. He gave us plenty of time, and it was good fun.
Yeah. Can you talk to us a little bit about the business? Like, what were the origins of the business, and how has it grown since?
So Escala Partners was formed in 2013. We, as I said, I'd worked at a global investment bank, and we were looking at providing an outsourced family office of sorts, and that outsourced family office was about providing portfolio management services specifically to wealthy families without perhaps the shackles of an asset management business or an investment bank. So we just wanted to have build a pure play wealth management business. And, we've grown significantly over that time. We're really proud of the business that we've created, and are passionate about providing these wealth services to large families and high net wealth individuals.
So, because the Escala name's really well known in the finance world, can you give us a sense of like the team or the size of the business?
So I work in a team of 7 within my specific team, and our area of focus is large families. Yeah. So we provide advice through portfolio management, portfolio construction, and succession planning services to the clients that we look after, and that's pretty consistent across our business. We have a direct investment group that focuses on investment grade credit or large fixed income portfolios, and that often works. That's a service that resonates quite well with either family offices or people that have just sold their businesses, and what they, having a facility that is direct investment grade credit, which is little risk, it's a good income, and it allows people time to plan for what is next. So we're Melbourne, Sydney. We have sort of 10 advisory teams, and So
the business has grown pretty well, and like I said, for people that are outside the finance industry, Escala's kind of held up as like a bit of a kind of the pinnacle of where wealth firms get to and the types of things that you guys do. I
think we've really tried to focus on what we're good at and stay in our lane. portfolio management for large families is a skill set that you need to develop, and it's specific. So we know what we're not. We're not stockbrokers. We're not lawyers. We're not accountants. We're not, we need to be very tax aware in the advice that we give. But if we're developing a platform that provides services specifically to wealthy families, then you learn about the traits of what constitutes successful families. What are the traits that perhaps that provide less than successful outcomes? So you learn, and you get better at providing broad advice that's consistent across people that have got, similar situations.
How does a family get ultra wealthy?
Good question. Good question. Well, I guess that it starts in that tier one, and families get ultra wealthy predominantly by building a business where they're taking concentrated risk. And that might be building a brand in a retail business. That might be in a logistics business. That might be through property. People have made a lot of money over the generations in property in Australia. And, that's generally how people get wealthy. They concentrate their risk in a business. Yep. Now, over the last 30 years, obviously, we've seen a huge explosion of wealth in Australia. We've seen economic growth over that generation, or over the last 30 years. It's provided a platform for businesses to grow, for businesses to float on the exchange. We've also seen capital markets opening up to Australians to provide a platform for access to capital. So we've seen private equity enter Australia. We've seen private equity based in Australia that have bought a lot of businesses. So, that first generation that creates that wealth, that's generally how it's done, through people taking a risk and building a business.
Would you say that there's anything that's common, or they share traits in that tier one category? Is there anything, if you think about some of the clients that you deal with, maybe the way they conduct themselves, perhaps?
Yeah. Well, I guess success breeds itself, and, a common theme is having a vision, executing on that vision. I'm a big believer in, belief. I remember when we started our business, it just didn't even occur to us that we were going to not succeed. And that belief in what you do, that vision of, creating something that providing a service, in our instance, providing a service, I think that, tenacity, perseverance, patience, all of those issues are pretty consistent. But above all, I'm a believer in sort of urgency, showing, hustling and showing a bit of urgency and doing what you say you're going to do. So I think that there's common traits across business leaders that obviously differ between different industries, but, that perseverance is a big one. Taking a risk, being patient, I think, is really important.
I like that phrase, actually, urgency. I hadn't thought about it like that. I'm thinking of a lot of the people that we've had on the show that have been very successful financially, and they do have an air of urgency about them. Like, they seem to be, it's not urgency as in they're in a hurry all the time. It's that they're really mindful of what they are and then they aren't doing, so to speak. Like, they're very focused, but also they want to achieve it, and they know that time is of the essence.
Yeah, I'm a believer in urgency. I think that, if you're structured in your day and you're trying to achieve a bit, then you've got to present with a degree of urgency. And I think that, I like if I say I'm going to do something, I like to do it, and I like to do it ahead of time. And if you're structured in your plan and you're showing that urgency, then I think it's often an ingredient to success.
Yeah. You said to me not too long ago this idea that a lot of the people that create this wealth have almost two careers, because they might go from creating this wonderful business that they exit from, or they've got some asset that they've exited from.
Yeah.
And then they instantly have to transition to, well, now I've got to manage all this money.
Yeah. And
it's two totally different things. Like, one is all about maybe hustle, and the other one's a different temperament that you need.
Yeah.
Use this phrase. You asked the question of rhetorical. You said, what does day one look like? What does that mean? What are you asking? What does day one look like? What does that mean to you? What does that look like?
So as an advisor, that's really important to me. So, if you think about someone that's had the hands on the lever of a business and they've lived and breathed that business for so many years, and let's say there's a liquidity event, let's say that they've sold that business, they're effectively changing careers. So when I say day one, what does it look like when you get a large lump sum amount of money, often in cash, land into your bank account the day after you've sold your business? What do you do then? And I think it's really important for an advisor to ensure that we're giving the right framework for decisions to be made thereafter. So when I say day one, it's about, you're starting a new career. So, what are the characteristics that you need to think about when you're effectively starting a new career? Because if you're running a really high quality operating business, it doesn't necessarily qualify you to then go into the investment business, which is fundamentally different. And so when we look at day one, we'll often encourage people who have sold a business, a large liquidity event, just to take time, go on holiday, take a chill. You've just gone through a big event and have some thinking music. And often that thinking music is build an investment grade credit portfolio with no risk, and then start the planning process. And that planning process is really important. Successful outcomes are contingent upon really strong and a lot of effort into the planning process. And there's a lot of things that will change from day one to, say, day 100 or 2 years down the track, because you haven't had the time to think about what life looks like after a very busy operating business. And believe me, you will think very differently a year on than you do on day one. And often people are in a hurry. So my encouragement is to start that process and think about what constitutes a successful outcome when you're moving from an operating business to an investing business.
Yeah.
And it's all about the planning, and that's so critical.
I think I had this this phrase that just because you might have $100 million doesn't necessarily mean that you're ready to build and manage a lifetime of wealth. And you alluded to something there where you've got that, I think you said investment grade credit portfolio.
Yep.
I think so some of the people listening to this would probably, maybe they're not surprised, but that might be quite unique for them to hear that.
Yeah.
So that day one portfolio may be just fixed income securities in some way.
Yep.
Yeah.
So Australia's fortunate in, given the size of our pension market, we've got a really deep bond market. And at Escala, we saw an opportunity to build, to build a portfolio of direct bonds.
Right.
So what I mean by that is that if you think about the banks to fund their mortgage books, they're not just going out and taking deposits or term deposits. They're actually issuing bonds, and they're issuing bonds into the institutional market. And that might be 3, 5, 10-year bonds. They might be floating or fixed. The majority is floating. And that's, in line with our mortgage market and our bond market. So for Australian investors to be able to buy investment grade credit or direct bonds, floating rate notes, we've built a business that enables, a large degree of sophistication in building a portfolio like that. It's down the capital structure slightly, and, without going into the jargon between, different levels of subordination in bonds, it's just a really good, safe pair of hands to be, as I said earlier, taking some time for some thinking music as you're assessing what next steps are and as you're building a critical plan.
One thing that most people listening to this would be familiar with, like a statement of advice or a financial plan.
Yep.
But one thing I know you spend a lot of time doing is an IPS.
Yep.
Can you explain what that is in your business at Escala? Like, what does that look like? What goes into it?
Yep.
Talk us through that.
So an investment policy statement is a guiding set of principles. But that is something that you develop in terms of what are we trying to achieve. And when you're selling a business or when you've sold a business, you might consider, well, what next? What are my liquidity requirements? What are my income needs? What's it cost me to get out of bed on the 1st of January every year? What capital needs do I have? Do I have lifestyle assets that I am looking to buy? Do I have debt that I need to retire? Have I got philanthropic ventures? So you sit down and you say, well, what are my liquidity needs? What are my capital needs? And what are my income needs? And most often people have got, who have sold businesses for large amounts of money, they've got more than they need. But an investment policy statement then goes into the portfolio construction. We'll look at things like the asset allocation strategy. How much do we want to have a look at building across cash, across Aussie fixed income, global fixed income, Australian shares, global shares, and then the increasing space called alternatives, which encompass direct property, infrastructure, hedge funds, private credit, private equity, and venture capital. So they're the kind of the subsections of the alternates. So an investment policy statement is a guiding set of principles. It says, right, what are we looking to achieve here? What's the asset allocation strategy? What is the role of each asset class? What's our return objective? What's our risk quotient that we're looking at? What levels of volatility are we willing to accept? So the investment policy statement comes at the back end of, how you're planning your family around governance and around all of those important issues that you also need to think about.
I wanted to play a bit of a game with you, or just say that Rask is. I have an exit from Rask, right? And I've put it in quotations here. The biggest podcast IPO in Australian history. To say this takes place, and I've got $30 million in my pocket, right?
In cash or shares that are escrowed?
Well, let's just say they gave it to me in cash. They were so confident that they took the business. Now I've got this much cash, right? I'm still young, I'm risk-seeking, I'm long-term, and I'm family-focused, right? So these are the values that I have. Like, what does that look like? Where do you begin as my advisor? Like, what are the things you want to know, and then what do we drill down into in that portfolio?
So that's a deep process of discovery, especially if we haven't known each other. You've just sold your business for a large amount of money. Where to next? And I think what's important to do is to cast your eyes onto the horizon. What do I look like in 5, 10 and 20 years' time? And, what am I looking to achieve? What are the next steps in my life? What's important to me? What's not? Do I want to keep working? So you're asking yourselves a lot of questions that perhaps you can't answer, but it's informing for the advisor to then build a portfolio that effectively is in line with those answers. There's no point in going out and building a fully invested portfolio if you're looking at reinvesting in a large business in the next 2 years. So it's about understanding where you're heading in your journey and what you're looking to achieve. I think that from a practical perspective, you sort of understand your balance sheet, understand the entities of which you're going to manage that wealth, be it a trust, a company, a super fund, etc. So they'd be questions that I'd ask in terms of what we'd look for. We'd then look and say, well, what's unique to you? What's your experience been? What are your attitudes to investment markets? What's your experience been in investment markets? What's your experience been with advice? Do you like receiving advice? And one of the things that's important to me is that your initial experience will very much anchor your attitudes. So as an advisor, I've got to be awfully careful to ensure that I'm capturing the right information and then I'm feeding back advice that's contingent to what your life is, your experiences, your aspirations. And that's an initial step, and that's a framework that you can start to build out a picture, and you can start to build out a story as to how we, build an investment portfolio for you initially, and then how we manage it. Because then your life changes. Your kids get older. How do you look at governance? How do you look at sort of a family constitution? All of those issues that are building on traits of successful families. But long-winded way of answering how you're going to manage your large amount of money. Plan, think about it, think about outcomes, think about variables, where to next. And as I said earlier, the best plan is to go on holidays, go and take a chill pill, and really think about what you look like in the next 5, 10, 20 years' time. And you might not have those answers, but those answers will come to you over time when you're thinking about it.
Do you think that with the aging population of business owners in Australia, I feel like that's a big tailwind for like your business and the way you go about things. Like I feel like there's a lot of entrepreneurial people that are coming towards an exit, and I feel like that's like a real strong structural thematic.
It's a structural thematic, but it's really important that advisors are equipped with the skills to be able to address that structural thematic. And that's about stepping back and really providing, I don't like this term, but holistic advice. And what that means is really assessing your family, your circumstances, where you are, and how ready the future generations are to receive that money. Because in some of the clients that we deal with, they will outlive their money. They will outlive their portfolios. So what's the structure and the governance and the family constitutions that enable a successful transition of that wealth? And for me, I've always been driven by, a view that it kind of beggars belief how many families disintegrate over the division of assets arising from death. So as advisors, we need to be better at facilitating the conversation in life around what are the traits of successful families. Well, it's communication. It's ensuring equality across the whole family. It's ensuring education. And, we don't educate our kids about the 101s of finance or how to invest. So let's keep it simple. Let's bring it back to what's important. But the tailwind that you talk about is happening. We're seeing, one, a transition of wealth across generations. And secondly, we're seeing, the baby boomers sell their businesses. And, we need to be ready to not just have a discussion about building investment portfolios, but everything around that. What are the goals? What are the objectives? What does success look like? What does failure look like? How are we addressing, the needs of our kids? So, I feel kind of passionate about it because I think that it's really important that we're facilitating the conversation so we can get successful outcomes because, we have not necessarily seen that in the past.
There was I did a little bit of digging into this because I hear a lot about money kind of disappearing over generations. And so I thought you'd be really good. You'd be really good at answering this question because I'm sure you get it a lot. There was an article that I read. It cited the Williams study, which had 3,200 wealthy families. And it said that the families lose 70% of their wealth in the second generation and 90% by the third generation. My question to you is, how does that happen?
Well, it's poor communication.
Right.
And it's often in the division of assets in the event of distribution through a will. And a will can't speak the words that it could have spoken while the person was alive. So I think that, non-communication of the values, how the money was made, an understanding about the responsibility that you have to pass that through to future generations. So, I think that overspending is a key theme. I think that, having, I referenced earlier, that feeling of your own sense of purpose and your own feeling of achievement. Every human needs to have that through work. But if you're, benefacted a bunch of money at a stage and you didn't choose, then maybe you don't go and pursue that career that you might have, or go and feeling that feeling of achievement that you might have otherwise felt if you've done something. So I think the poor communication through generations, I think overspending, I think lack of planning, lack of governance, lack of structure, they're all issues that have led to inferior outcomes. And I think that we can now, with that understanding, with the governance structure, building investment policy statements, building, a set of tram tracks around how to manage money, understanding that if you spend more than you save, or if you've got a depleting capital pool from overspending, then, that will lead to an inferior outcome.
I love this line that you gave to me recently, having your own feeling of success, your own contribution and intellectual stimulation. And you alluded to it there. I think a lot of people listening to this probably have heard the phrase like easy come, easy go kind of thing. How do you try and instill that? Like, how do you try and instill that value in your clients and encourage them to educate their children and to allow their children to kind of, grow and to feel that success?
Well, I think like my own family, for example, I think that it's important that you're instilling your own values. And I think we use the word values to liberally these days, but it's really important. What are your values? What do you believe? What drives you every day, and how do you communicate that to your family? Having a conversation about what does it mean to be a part of this family, and what do we expect from a behavioural perspective? What do we expect? Not anything. You've got to let your kids go and do what they want to do, which is something so important to me. But facilitating a conversation, ensuring that we're educating, is so important. Understanding it's not about what is a share or what is a bond, but what are the key criteria to success? Well, to investment success, I should say. Well, it's don't concentrate your risk, don't speculate, don't overgear, and make sure that you save more than you spend. If you follow that philosophy, then you're going to be okay. So when I talk about, your own feeling of success, it's about, I guess imparting that wisdom or having a conversation around education with your family.
What about like the idea of creating a life that's fulfilling? Because a lot of the people that say create that significant amount of wealth and now you say go on a holiday, a lot of them probably feel like a big part of them is gone now because they've spent their life toiling or, involved in a business. Like how do they regain that feeling of fulfillment?
It's really hard. It's all very well to sell a business or move on to a different phase of your life. It's about adjustment, and it's about giving yourself permission to take the time to move on to the next phase of your life. Everyone's different. Everyone will adapt differently. Some people might say, I've just spent the last 30 years of my life working as hard as I can, taking risk. I don't want to do that anymore. Maybe it is time for me to move on to a different phase of my life. Other people might say, you know what, I need that invigoration. I need to keep going. So everyone's different. But I guess to maintain your own sense of fulfillment is your own health across, so many different areas. But, I'm in a really fortunate position in that, I see high achieving people and high achieving families, and, often they'll move on and they'll regain that sense of purpose, or they'll regain that sense of fulfillment through family means, their own pursuits. They might have endeavours that they have been wanting to do, but look, everyone's different.
It's interesting because you create that significant amount of wealth, and then I guess you are in that mode where you might be excited about the wealth that comes, what the opportunity is from that wealth. I'm curious to know, like, I imagine you have quite a few conversations with clients in that, like maybe at the time that they're planning to exit or have exited, because sometimes these things take years. And they do have that, probably that burst of enthusiasm, I'm imagining, where they're like, well, I've got all this money now. I could go and do this, and this. Is it as simple as saying go on a holiday? Like, what are some of the steps that you might put in place?
Well, that's a flippant thing for me to say in terms of just take some time out to plan, because you don't know what your life looks like after you just take a step back and settle. But, it's about understanding, kind of what you want next. So, take that time and start planning. And, often it can generate feelings of, people can be terrified. Is my life different? How am I going to regain what I had? And starting to invest that money can be really challenging. So, there's a good old-fashioned phrase about dollar cost averaging, but dollar cost averaging comes after you've set up a strategy and a plan, and what does that look like? And so you run a whole heap of different scenarios to ensure that you're comfortable with moving forward. And then, as I said earlier, take your time. You don't need to build a multi-generational portfolio overnight. You can slowly add risk from a non-risk asset class, or a lower risk asset class in fixed income. So when you take your time, you're building a portfolio that's fit for what your needs are. But, often we've had clients that have sold businesses and it's taken us 3 to 4 years to get towards full investment. But that's good. Give yourself permission for time. You don't need to generate return overnight. You need to build yourself a framework by where you can, get to where you would otherwise get to without taking risks that would cause you to second guess. As I said earlier, your initial experience will anchor your attitudes. So if we're investing our money on the back end of 2021 and you say, right, I want to get active and invest the whole portfolio, well, you've had a pretty terrible experience by the time that June 2022 comes around. And that can often anchor your attitudes around investment going forward. So if you had have gradually invested and staggered in over a period of time, which is the sensible way of doing it, sensible and common sense, they're the themes that you take. But everyone will go through different experiences when they have an event like selling a business. And it's about taking your time to adjust and work out where you're at and what your family looks like and what your next few years looks like. Because in my experience, often that changes over a couple of years.
I wanted to ask you a question. For people that aren't, let's say, as affluent financially, they might be thinking, well, I don't have a significant amount of wealth to pass on to the next generation or to my kids or grandkids. But you obviously have a lot of experience in non-financial things that people can pass on and lessons and values in that. What would you say to people that don't have the financial means but still want to leave a legacy, whatever that might look like to them? Like, what would you say to them?
Well, I guess that's about imparting your knowledge and your values. I'm a values person. For me, I believe in honesty. I believe in integrity. I believe in loyalty. I believe in doing what you say you're going to do, all of those principles. So you can always, impart your wisdom on future generations. I think education is really important. As I said earlier, we don't educate our kids as to how to build, parallel wealth for themselves outside of their jobs. So we should be, taking a step to provide education around simple issues like saving more than you spend, or dollar cost averaging on a regular basis into basic index funds. Speculating comes with costs, and often that cost is losing everything. Don't overgear, all these type of things. But more broadly, there's some amazing people out there, and you don't define yourself on the balance of your bank account. It's just that's just, in my experience, futile. There's some amazing people out there. So part your wisdom, have communications as families. I like the phrase, what does it mean to be a part of this family? And, what are some of the things that have led to my success? And, passing on that wisdom, I think, is important.
Do you talk to your family about money?
So there's a really great friend of mine that started a structure called a family AGM.
Okay.
And he'd sit down every year with his family, and he would have an agenda and a structure. But it was simple as going around the table at the end of every year and saying, tell me about your year. What were the good things? What were the bad things? And what are your objectives for next year? And then that gave, then you come around to your mum and dad, or to me and my wife, for example, and you talk about your own life, what your challenges were this year, what you achieved, and what you need for next year. And then that opens up to a discussion around a whole heap of other things around what we want to do as a family. What does it mean to be a part of this family? You can then broaden that into, what does business mean? Dad, you've run a business. Tell me about that. You were stressed then. Tell me about that. So it's just a platform for conversation where you could perhaps take stock of what your year has been and look forward to what your year looks like next year, and communicate as a family as to how you can help each other. And then you can have a framework that discusses what's a balance sheet. What's a company, what's a trust, what's a super fund. So you can build a sort of a more semi-formal kind of get-together at the end of the year. So, I've always taken some good guidance from my friend who does that, and I thought it was an excellent idea. So it's a platform to enable a discussion.
Yeah, I just like that, the prompt and just giving them, just prompting them to buy in with the conversation, and having that, like you used to say, a platform just to have the discourse.
Yeah.
So say someone's listening to this, right, and they might be coming up on selling their business, or maybe they already have and they've come into some wealth. How does someone like that get in contact with someone like you?
Well, do your research. I think that the advisor-client relationship is just that. It's a relationship. It's someone with whom you have to trust. It's someone with whom you will need to develop rapport with. You need to develop a relationship with. I often say that, my job is, I'm in the communication and relationship business. Obviously, I've got a framework of skills that enable me to provide advice based on portfolio management. But for someone that is approaching the sale of a business, it's a highly emotional time. It's a highly vulnerable time. And to have someone there that can guide you to, what are the things that I need to be thinking about in advance of a change of my life? What are some of the things that I need to be thinking about from a tax planning perspective, a succession planning perspective, an estate planning perspective? You've got to actually understand some of the things that you might need to be asking, and you might not know that. So it's about finding someone that you can have that rapport with and have a conversation with around next step. And it's not one conversation, it's not 3 conversations, it's probably more like 10, and you're having a regular dialogue around those points that enable you to make fully informed decisions and take your time.
I like it. Okay. So I'll put links in the podcast show notes, and for the YouTube viewers in the description to the Escala website and to Scott's profile, so you can reach out to the team if you need to. My final question is more of a philosophical one, and it's one that I always ask people who are on the show for the first time, which is the advice you would give yourself if you went back in time, whether it's finance, whether it's business, whether it's life, whatever the case may be. What would that advice be?
Good question. It's a journey. It's a journey with ups and downs, and accept that it's a journey with ups and downs, and try and enjoy the journey. Often I look back and, you get built up in the daily machinations of life, and you forget that you're on a journey. So, take stock and enjoy your kids at their early stages. With me, with kids in my early to mid 20s, it goes like a flash, and people say that. So enjoy the journey a bit more. I think, a big lesson for me is save more than you spend. Start investing early. The power of building parallel wealth next to your superannuation fund through having a regular savings plan in your 20s is so important. I talk to, my friends' kids about what are the things you need to do. Well, it's not about speculating on stocks. It's just simply about having a regular savings plan, because I guarantee you turn around as a 50-year-old and you've had a regular savings plan since a 25-year-old, you'll be very, very thankful that you've done it because you're really building something for yourself in the future. But it's save more than you spend. Read widely, read some good books, and, educate yourself. That's the lesson to my, call it 25 or 30-year-old self.
I like it. That's great wisdom, and I know your time is precious, so I really do appreciate you coming down the other side of the city and doing this with us and sharing some of your knowledge with the community. So really appreciate it, Scott.
Oh, it's been a pleasure talking to you. Thank you.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.